All right, folks, thanks for taking the next step and joining the webinar. I'm going to make this as brief as possible because if you're like me, attention spans are short. So let's get into this. Who, what, why, RYM? Replace your mortgage. That's the acronym for replace your mortgages, RYM. So if I refer to it moving forward as RYM, you know what we're talking about. It is replace your mortgage. So here we go. Here's my goal. You're going to learn that there's a far better way to becoming financially free using a tool that tons of banks and lenders have against them. Now, this is not a gimmick. It's a simple math solution that is proven to decimate your mortgage balance and have you debt-free fast. And when I say proven, I mean millions of folks are enjoying this strategy to not only pay off debt, but also build wealth. And it's legal. This is not a scam. In fact, as much as 80% of homeowners in Australia and the United Kingdom are paying their homes off in less time than it takes some folks to pay off a simple car. Now, if you stay until the end, I have a free gift for you. So please pay attention and please stay to the end, because if you do, I've got a free gift that I'm going to give you for your patience of listening with me today. So why are you here? Have you ever wondered why some folks are able to survive or even take advantage of a crisis we face today? And are you tired of surviving and not thriving, but feel you need to catch a big break to fulfill your lifelong dreams? Then I promise this technique will eliminate your stress and you will begin to take control of your life. You are here for a reason, and I promise I'm going to show you the solution. Now, who is this for? This is extremely important, so please pay attention to this part. Because at the end of this webinar, I'm going to request that you book a free consultation with us, but only if you meet this criteria, and this is specifically who this is for. So this is for homeowners or those that want to be homeowners but do not want your debts to dictate your flexibility. Pretty obvious, but here's the biggest part. Ideally, you're going to need 20% equity or down payment. However, I found numerous banks that offer this product with 10% equity. And do you have sufficient credit and discipline? Not perfect credit, but at least a 680 plus credit score. Also, this is not a magical pill to becoming debt free. You're going to need discipline over your budget to accomplish this feat. And are you cash flow positive? Do you make more money than you spend? So for instance, let's say you've got $5,000 a month coming in. You should not be looking into this if you are spending $5,000 per month. If you have discretionary income left over, that's who this is for. Now, how's this different? This is not a HARP loan, Streamlined refinance, nor any other type of traditional mortgage product, but it is using a product that banks have had for decades, a simple home equity line of credit. And it's a simple financial tool used by wealthy individuals and corporations to build empires. And this is a simple cash flow strategy not taught by banks, bankers, or loan officers. Why? Because they're going to lose money. And obviously, they're going to lose your money. Now, who am I? I've been a banker or lender for 17 years. I'm the CEO and founder of Lush Enterprises, which is also known as Replace Your Mortgage. I've closed thousands of mortgage transactions, and I despise non-leveraged consumptive debt. I'm also a proud father, as you can see, and husband. Now, I've done a lot of things right. I was awarded a full scholarship to play college basketball, overcame life-threatening illness and bounced back. I worked hard for my family and rose the corporate ranks fast, and I've always had a heart for helping and serving others. And I'm married up big time, as you can see from the previous picture. However, I have done a lot of things wrong. I bought lots of luxuries, liabilities, and debt. I worked way too much. I refinanced my home numerous times, chasing low rates, and I didn't invest. In 2005, I even refinanced my home equity line of credit to a mortgage, which was a big mistake that I didn't realize until 5 years later. Now, after doing this for 17 years, I discovered I was the rat on the wheel. And I discovered I wouldn't be debt-free for a long time or ever. And I discovered I would not be able to retire or become wealthy maintaining the status quo until I stumbled on something truly life-changing. And I discovered this the hard way. You're going to get the cheat sheet and get the easy way. And what's the hard way? The hard way is financing debts on long-term installment loans with low rates. Yeah, I said it, low rates, low payments, and trapping your equity, making minimum payments like on a 30-year mortgage, and giving the bank your savings at 0%. Now, if you want the easy way that I've learned, here's what I'm going to do. I'm going to let the cat out of the bag. So why am I doing that? Well, because my life focuses on four main principles. Number one, faith, family, finances, and freedom. Morally, I cannot keep this a secret, and I must right the wrong one family at a time. And I've been blessed, and now I want to bless. So I want to transform lives. Knowledge is power. I can't take credit for this, and I did not develop this strategy. In fact, it's been around for decades and very popular in other countries. And I've been implementing this strategy for 8 years. I've helped over 5,000 clients achieve their dreams, and now it's helping protect them from the economic collapse the country is experiencing today. And this may sound too good to be true, but it's not. It's just a simple math solution and a cash flow adjustment. Now, is it a get-rich-quick scheme? Absolutely not. In fact, it's going to take years depending on your income and discipline, but it will take decades sooner to get there. And if you do nothing, I can promise you, you can expect nothing. Now, we've all seen this. This is a mortgage amortization schedule. So on the left-hand side, you see how many payments, 0 through 6. You see what the payment is and how much of that payment is going towards interest and principal and what the impact is on your balance. So it obviously looks familiar, but if you add up the payments, that adds up to $7,783.20. And this is on a $200,000 mortgage that is at a decent interest rate, but your balance only went down by $1,047. So who's really winning in that solution? So let's follow the money. So let's say you have a $250,000 home and you financed it for 30 years or 15. Let's go through it one at a time. So let's choose the 30-year term. So as you can see, $250,000 home financed at 30 years, the payment is lower. And that's what we do as Americans is we focus on what we can cram inside of our monthly budget. And as long as it meets that budget, we're fine. But Europeans, South Africans, Australians, and such, they look at financing real estate through a different lens. They look at the actual cost of the home, not just what the purchase price is, but also the cost, including financing. So as you can see, on the 30-year term, you're paying $206,000 and a total paid for $456,000. Now, if you cut the term in half of 15 years, yes, your payment goes up substantially, $700 a month, but you also have decreased the interest paid by over $100,000, actually $112,000. But you still paid $344,246 on that home. So you got to ask yourself a question. If you financed a $250,000 home over 30 years, at what point do you earn, or is that a wise investment if you were to sell? You would have to sell the home if you financed it for 30 years for north of $456,000 in order for that to be a wise investment. Now, some investors would tell you, well, if you buy a $250,000 home and then you can sell it for $275,000, you made $25,000. That's not the case. Only if that is the case if you sold very quickly after purchasing it and you didn't incur any financing cost. But if you kept that home for 30 years, you would have to sell it for over $456,000 in order for that to be a wise investment. So you got to ask yourself, the home that you're purchasing or that you're financing, including the financing cost, is that a wise investment? So you're going to pay far more than your home will be worth. You're also going to be paying mortgage insurance, which further inflates the cost. So basically, you don't own the home. You're just renting it from a different landlord. This time, the landlord is the bank. Now, did I mention mortgage insurance? So mortgage insurance is when you have less than 20% equity or as a down payment. So for example, FHA, they charge 1.75% upfront. VA is up to 3.3%. USDA is 2%. Conventional is cheaper, but you also have a monthly mortgage insurance premium as well. But what is the benefit to you as the consumer with mortgage insurance? And don't confuse it with mortgage protection insurance, because mortgage insurance does not protect you. It only protects the banks. There is no benefit whatsoever to you as the consumer. Now, if there's a better way, then why doesn't the bank tell me? Well, number one, they don't want you to know. The more interest and closing costs you pay, the more profit they make. So refer to your mortgage statement as an example. And number two, and this is probably the most important one, most bankers don't even know about this strategy. They are institutionalized just like I was. And they think the only way to save you money is to lower your rate or reduce your term by drastically increasing your mortgage payment. So let's talk about segregation of income, because that's really why a mortgage came about after 1913, is it was designed to segregate your income. It was never meant to be efficient for consumers. So this is what it looks like. You've got your income coming in, then it's going to your checking account or your savings account or both, and then you're going to pay your car, and then you're going to pay your home. So you're massively segregating your income resources. And that's all designed to segregate the income to prolong debt and increase interest paid. However, this is what a streamlined income approach looks like. Income comes in, it goes to your home equity line of credit, which is also your bank. Then out of your bank or your HELOC, you're paying your expenses and bills. And then what you do after that is you repeat. And as long as you're cash flow positive on a simple interest open-end line of credit, not only are you liquid, but you're massively reducing the balance. Thus, you're reducing the interest paid, and you're also reducing the time in which it gets paid off. Now, let's talk about a checking account, because a checking account is actually a liability. I remember in my early 20s, being in the mortgage industry, folks bragging about what you had in your checking account. Well, a checking account is a liability. I now know that now that I'm in my 40s. The average rate of return is 0.17%. That's a nationwide average. Inflation is 1.6 to 3.3% per year. So your money is losing value. You're getting 0% on your dollars in a checking account. However, when you pull your money out, the cost of goods and services have increased. So the average rate of return that you're getting on your checking or savings account doesn't even keep up with the cost of inflation. Hence, it's a liability. So here's the solution. Finance your new home or replace your existing mortgage using a home equity line of credit. Now, a specific one, a first lien position home equity line of credit. That may confuse folks, but all it is a simple refinance. Instead of refinancing from an FHA loan to a conventional loan, you would be refinancing your FHA or conventional loan into a home equity line of credit in first lien position, not second lien position. That's what we typically think of when we think of home equity lines of credit. But I'm going to guide you on getting the proper home equity line of credit. Now, you also need to change where your cash goes. This is step 2. Stop giving the bank your money at 0% so they can turn around and lend it back to you at 4 and 5%. Dump all of your income into the HELOC. And don't worry, money can go in and out of a HELOC freely. It's open-ended, 24/7. You'll actually get debit card, checks, online banking, etc. with your home equity line of credit. So now that can act as your bank and your real estate loan all in one. Now, you're going to pay your bills out of the HELOC just like you would with your checking and savings account. And the remainder goes towards the balance, thus reducing the interest you pay monthly. Now, corporations have been doing this for decades. Businesses have built huge empires utilizing business lines of credits. Businesses don't typically use installment loan type debt. They use a more efficient financing tool, which is a line of credit. And because it's the cheapest way to borrow money. It's the fastest way to pay off debt using sweep accounts to funnel revenue back into the line of credit. So here's an example. This is an example of a household making $5,650 in income on a $250,000 mortgage. So I put in a high interest rate, one that is not typical in today's environment. I also said that rates would increase 0.5 point every single year. Now, that's also not indicative of this environment. Rates have plummeted. Now, they will eventually go back up, but going up 0.5 point every single year is not normal. Net monthly income is $5,650. Let's also say that this household also has $3,000 of expenses. Now, this $3,000 of expenses is not including the mortgage. Now, why is it not including the mortgage? Because you don't have one anymore. You just refinance it into a home equity line of credit. So don't make the mistake of having your monthly expenses and then add a mortgage payment on top of it, because you would stop paying your mortgage lender because you don't owe them a penny anymore. Now you owe the bank that holds your HELOC. Oh, let me go back. So as you can see, you would pay this off in 135 months. Now that's outside of our additional strategies that we teach within our course that can accelerate this another 15 to 25%. But 135 months is just a little over 11 years. Now that's not our average. Our average client pays their home off in 5 to 7 years. But I just wanted to show you something extremely conservative. If interest rates increase every single year, if your income never increases for 11 years and your expenses never decrease for 11 years, you would still pay your home off in 11 years versus a 30-year term or even a 15-year term. So that's a 19-year savings without breaking a sweat or changing your budget. You're just using a more efficient debt tool. So, but maybe you're not here to thrive yet. Well, let's face it, in today's economy, maybe you're here to learn how to survive. And maybe we just need to weather the storm together. And did you know in the last recession, folks with a first lien position, home equity line of credit, had a lower default rate than folks with a mortgage? You heard that right. In the last real estate collapse, folks having a HELOC did not default on their HELOCs nearly as much as those who had traditional fixed rate mortgages. I'm going to show you why. So, how to use a HELOC. Many banks may send a bill for the interest only payment. However, if you have sufficient equity and don't pay, they will add the payment to your outstanding balance. So let's use a $300,000 line of credit. So if you have $200,000 that you owe on that, but the limit is $300,000, that's the key part, your minimum payment could be $832. And if you don't pay the interest, your balance on the line will increase to $200,832. So as the balance increases, so does your minimum payment. So I just want to get that out there. Yes, your balance will increase, and therefore your minimum payment will increase because this is a simple interest loan. Now, here's what that looks like. So, went too fast again. So as you can see here, these are the months. So months 1 through 24. This is if you're making no payments toward it, right? And then you've got your interest only payment of $832, and this is what your balance is doing. So let's say you had a $300,000 line of credit and you've had income reduction or an income depletion. Your income completely went away. You're able to utilize this HELOC to pay itself. So you don't even have to make a payment. On some HELOCs, you don't even have to make a payment. They're just going to pull it from your line of credit, and they're going to apply it towards the balance. And again, as you can see, your minimum payment goes from $832 to $916. But this is 2 years of attributing nothing, absolutely $0 to your home equity line of credit. Now that's 2 years. You could actually go further because you have a limit of $300,000. But surely within 2 years, you've gotten back on your feet, you've gotten your income back up or back to where it was, or at least something that you can contribute to the home equity line of credit. This is if you contribute $0 to it, you can actually survive. And that's one of the reasons why folks in the last real estate collapse were able to weather the storm. They didn't even have to make payments on their home equity line of credit. But again, this too shall pass. Your HELOC can help you last for years. But this course is going to guide you step by step and show you how to use this tool efficiently and still reduce the balance. And we'll show you how to use it as an income source, not just something that you don't make payments on, but actually something that can make payments to you, just like businesses do. Now, is your mind blown yet? So let's get started. What you've just seen is just a snippet of a 10-part course I've designed to walk you step by step through the process, and you will be my client until you reach your goals. And I'm going to show you where to get the right product and how to structure it and how to implement it. Now, your alternative is to maintain status quo, giving hundreds of thousands of dollars away to your bank. I love this graph because look at the difference of the top 1% versus the lowest fifth. Now, there may be differences in opportunities, but we all have access in this day and age to knowledge. And I can tell you something that the rich do that the bottom, middle fifth, or lower fifth don't do, and that is exercise on that knowledge or implement the knowledge that we gain or even request the knowledge that is freely out there. And as you can see, the lowest fifth, they are losing net worth from 1962 to 2009. However, the top 1% have massively gained net worth. And I'm going to show you how that's possible and how you can go from the lowest fifth to the middle fifth to the top fifth, the top 1% very quickly. Now, again, this graph is the reason why the rich get richer and the poor get poor by design. You determine which one you will be. Again, you will determine which one you will be. Now, is it right for you? Before you book a call, let me tell you exactly what it does so you know if it's right for you. And you know you're obviously serious about improving your finances, and I just want to take some time to acknowledge you for doing that. You wouldn't be on this webinar if you weren't willing to take the time to gain this knowledge and improve your finances. Most people never take time to educate themselves the way that you just have. And at the end of the day, it's math, not magic. So fact one, you now know that a traditional mortgage is a slow, painful way to pay off your debts. Fact two, you now know that this is a cash flow strategy and it's a simple math solution to rapidly pay off your debts or leverage it to your advantage in a time of crisis. And fact three, you now understand the importance of time and money, and the best time to start saving money and protect your family is now. Time is a commodity. Time is the world's most valuable commodity. Rich people buy it and poor people sell it. So make no mistake, this strategy is buying time. And are you trading hours for dollars, or is your money working for you? you pay for what you get. This webinar was designed to give you the basics of what we teach, and I wanted to offer a valuable course at a low price point so more folks can get in the game and start playing. But I didn't spill all the beans and divulge some really cool strategies taught in this course. So let me give you a peek at what that looks like. This is a Facebook group that we utilize to corral all of our platinum clients. As a platinum client, you'll receive access to this Facebook group. And as of the recording of this video, there's 3,000 members in there. Lots of those are CPAs, financial planners, real estate investors, and such. So it's a huge community and growing by the day where you can chime in, ask questions, and not only get feedback from myself and some of my coaches, but also others that have been doing this exercise for 3 to 6 years. Now, this is Matt. He's in a live training, which is something that we do on a regular basis with inside of the Facebook group. Here, he's teaching on promo rate stacking. Actually, this is part 2 exercise of promo rate stacking. He's adding value, and every day we learn, so do you. So as we come across new strategies and new bank products, we're going to get on the Facebook group and we're going to share that with the masses. And the other strategies used to further accelerate or decimate the balance of your home equity line of credit. Now, this guy, he managed billion-dollar portfolios for Wells Fargo. But as you can see from his paraphernalia in the background, you can barely see his hat. He's a Bears fan, so nobody's perfect. Now, here's the course outline. Module 1, the banking scam. That's a $97 value. Module 2, why banks don't want you to know. That's also a $97 value. Module 3, what is a HELOC in the correct one? $300 value. That's extremely important. Module 4, guidelines, requirements, and how to navigate the maze. It is difficult on your own. That's a $300 value. Module 5, applying the strategy and gain efficiencies. $1,500 value. Module 6 is turning a liability into an asset. We have many, many members that have done that. They've gotten into real estate investing, they've quit their full-time job, and they've leveraged their liquidity in order to buy other cash flow assets that exceed their income at their job. Module 7, how to survive during an income crisis. So I did a snippet of that, but it's very technical, and we get into some granular details and teach you how to do that. Module 8, HELOC automation. In this day and age with technology, you should just wake up and focus on making money, not paying bills, and we can show you how to automate that process. Module 9, bank questionnaire. It's 29 powerful questions to get what you want. We have to ask powerful, good questions in order to get powerful, good answers. And my favorite, infinite banking concepts. So what I've taught you thus far is how to replace the mortgage lender, but you're still replacing the mortgage lender with who? A bank. Well, you don't own the bank. In our infinite banking concepts course, we're going to teach you how to become the bank. That's a $2,000 value. Credit repair course. So some folks are struggling with their credit. Again, we want you to have a 680 plus credit score before you book a phone call. But let's say you want a 700, 720, 800. We actually have a credit repair course to show you how to increase and maintain credit scores. In advanced HELOC trainings like promo rate stacking and many more, that's a $600 value. So that's a total of $8,000 in value. And these are real products that we sell for that price. So this is an $8,000 value. But I know what you're asking. Seriously, dude, what's the price? And again, we have over 5,000 clients that gladly paid and put themselves in a better financial position. Every day we get updates on their success stories. Just before recording this, I got a phone call from another Michael, obviously not me, but a different Michael, who's a client of mine, who's been a member for several years. And he said he just paid off his home and now he wants to talk about investing. That's great. It sounds great. But I wish he would have called me along the way because he could have been investing this whole time to further accelerate paying off his HELOC. But again, we're getting these success stories every single day. And I want you to be another one. But I understand these times are difficult and uncertain for a lot of you. And you're scared, and I don't want you to be scared of the price. So it's $0. That's right. It's free. You read that correctly. We don't charge a single penny for you to have a 45-minute consultation with one of my consultants. And we're going to determine if a HELOC is best for your situation. Now, our program is not a one-size-fits-all strategy. So before you contemplate becoming a client, we want to vet you first. We want to have that free 45-minute conversation to see if this makes sense for you. So let's do that. Let's spend 45 minutes answering your questions, your concerns, and calculating your debt-free date. And even if we agree for you not to move forward becoming a client, you will part with invaluable information and homework to get you on the right path. So you have nothing to lose and everything to gain. But what's my free gift? So first off, Thanks for indulging me today. Secondly, I want you to part with even more value. I wrote a book that gives a little more detail. And as a gift, I want you to have this life-changing book free. So take advantage now. If you're interested in our teachings, click the link below to book a free discovery call. And if you decide to become a platinum member, we will show you how our services will save you far more than our membership fee. We do that every single day. And within 2 months, it's actually not costing you anything. It would cost you not to do this. And we're going to show you how to skip 2 months of HELOC payments if you close appropriately. And our average client, now we have some that are far more than this, but our average client saves $15,000 in the first 6 months or $30,000 a year. So click below and have your mind blown. Lastly, and most importantly, take care and God bless you, because He already has.